Welcome to today's session on anti-money laundering under the Prevention of Money Laundering Act 2002, commonly known as PMLA. Money laundering refers to converting illegally obtained money into apparently legitimate funds. Section 3 of the PMLA defines money laundering as directly or indirectly assisting or being involved in activities connected with proceeds of crime and projecting them as untainted property. The Act aims to prevent criminals and terrorists from misusing the financial system and ensures transparency and accountability in banking operations. Money laundering generally occurs in three stages. The first stage is placement, where illegal cash is introduced into banks or financial channels. The second stage is layering. Here, criminals create multiple transactions, transfers, or investments to hide the original source of funds and avoid detection. The final stage is integration, where the laundered money is brought back into the economy as apparently genuine or legitimate income. Understanding these stages helps banks identify suspicious transactions and prevent financial crimes. Terrorist organizations also use financial systems, similarly to business entities. Their financing activities generally involve four stages: raising funds, moving funds, storing funds, and finally, using funds for unlawful activities. The key objectives of anti money laundering measures are to stop criminals from using banks for illegal purposes, prevent the spread of financial crimes, protect the economy, and stop terrorists from accessing financial resources. Under the PMLA, money laundering is treated as a serious criminal offense. Section 45 states that offenses under the Act are cognizable and non bailable, meaning law enforcement agencies can investigate and arrest without prior permission, and bail is not easily granted. Section 4 prescribes punishment for money laundering, which includes rigorous imprisonment ranging from 3 years to 7 years, along with fines. In cases linked to narcotic drugs and psychotropic substances, imprisonment may extend up to 10 years. Financial products and services are designed for convenience and efficiency. However, criminals misuse them for money laundering and terrorist financing activities. The primary source of ML and FT risks is customers, especially when their identity, profile, or transaction purpose is suspicious or unclear. Risk is also influenced by the type of banking products offered, geographical locations, branch operations, and the nature and value of transactions. To mitigate money laundering and terrorist financing risks, banks are required to follow strict AML measures. These include proper Know Your Customer or KYC procedures, customer due diligence, continuous transaction monitoring, and reporting suspicious transactions to FIUIND. Thanks for watching.